And we now move to our first roundtable discussion of the day. But first, we have a short film to illustrate why monetary architecture is once again top of mind. Let's take a look. And to explore how central banks can adapt their policy tools while maintaining independence, please join me in welcoming James Bullard, former president of the St. Louis Federal Reserve Bank, currently Dean of Purdue University School of Business, as well as president of the French Academy of Moral and Political Sciences, the former president of the European Central Bank, Jean-Claude Trichet. So, gentlemen, welcome to both of you. I'm going to start with a question for you, Mr. Bullard. As Janet Yellen described, central banks operate in a more fragmented and a more uncertain environment than a decade ago. So how would you describe the emerging and even the current monetary order?
Yeah, I think, well, it's great to be here, and it's great to see all of you. I think for the current environment, if we're just thinking about the next 10 years, and Janet Yellen emphasized fiscal situation in the US, but I would stress around the world, governments are don't seem to be very interested in raising taxes or reining in spending. You know, this is going to cause problems at some point in the future, and then that's impinging on central bank independence by extension, I think. And so you're inching closer to a poor policy mix that we have seen in the past, which was in place in the global order in the 1970s. I'm not saying we're seeing the 1970s yet, but we're inching in that direction. Undisciplined governments, and central banks that do not have a good coherent plan and do not target inflation. There were no inflation targets in the 70s. Lots of exchange rate manipulation. So that led to a lot of volatility. It led to a lot of recessions in many different countries over time. So that's the scenario that perhaps we've lost a little bit of memory about, and we need to remember now that fiscal discipline actually pays off in the medium term and the long term, and central bank independence also pays off in the medium term and the long term. You want to do as much as you can to encourage technological improvement and rising standards of living, and not allow this sort of political drift to send us back into a situation that we've been in the past and did not work in the past.
Thank you, President Trichet. Following up on that, central bank independence, traditionally it's been a key pillar of monetary credibility. Do you believe that this independence is getting harder to maintain?
I would share certainly the view of James that with big imbalances in the fiscal side, and more generally, perhaps in the reform side also, speaking for Europe, we have a problem for the policy mix, and it has, of course, an influence on central banks. Still, it seems to me that we had a recent experience of central banks being fiercely independent, I have to say, after the surge of inflation at the moment of the post-COVID recovery. The Fed increased rates by 11 times, the ECB 10 times, and still there was already the sentiment that after all, with the deficit, the fiscal deficit and so forth, there was more or less central banks that were less independent than before. They proved that they were as independent as before, at least before since a long period of time, but not, of course, at the time of the first and second oil shock, which were the demonstration and independence of central bank was really key to be sure that we could deliver stability, price stability and financial stability. So I am not too worrying personally, particularly in the case of Europe, where the independence of the central bank is guaranteed by a treaty, not simply by the law, as is the case in the US. Still, the Fed reacted extremely well, in my opinion, to the attacks of the President of the US, and Jay Powell did a good job. All the Open Market Committee did a very good job, and they preserve their own independence until now. But I have confidence that it will continue to go along this line, personally. Maybe I'm too optimistic.
Well, time will tell, I'm tempted to add. James Bullard, other than what we just talked about, this increasing involvement of political forces in monetary policy, central banks must also increasingly deal with unexpected shocks and evolving information. So how is this changing the way policymakers assess risk, communicate and sustain that all-important market confidence?
Yeah, during my time on the FOMC, we were hit by two very large shocks that were really, I would say, almost completely unanticipated. One was the global financial crisis. I think the feeling, at least on the US side, was that something like that could not happen inside US financial markets, but it did, and it caused tremendous repercussions in the US and around the world. And the pandemic, one of those things that, you know, if you had pressed any of us, we would have said, yes, that's a possibility, but we also would have said a very small possibility, and we're not going to worry too much about it. But again, a major shock for the US economy and for the world. So I think this has highlighted for me that the distributions of risk have much fatter tails than we tend to acknowledge in day-to-day conversation and day-to-day market pricing. And I think it's to our detriment that we don't plan enough probably for tail events. Now there's some more emphasis, I would say, based on scenario analysis, which is becoming more popular in central banking circles. Some of you may have seen former chair Ben Bernanke about a year ago put out a possible way that the Fed could map out scenarios in its as part of its dot plot or forecast scenario planning. Scenarios, I think, are good, and I think it does help people crystallize in their minds some of the paths that could possibly occur and how to do the market pricing and the returns in those situations. I would say, though, that scenarios have their limits. There's some things central banks cannot say in their scenarios, such as, I think we will lose control of inflation and things will be terrible, or a new government has come to power that is going to wreck everything. You know, that kind of thing cannot be in the scenario planning. But the private sector and all of you in your investing have to mark some probabilities on these types of things, and certainly for the U.S., but all the countries around the world. And so in some ways, I think it's got to be a partnership between central banks and their outlooks and the private sector and their outlooks in assessing risk going forward.
President Trichet, what makes the work of central bankers even more difficult in today's day and age is shifting geopolitics. We have geopolitical fragmentation, more assertive regional blocs. So is the international monetary system moving towards multipolarity? What role in preserving stability here in Europe, and what role can Europe play in this, in trying to preserve stability?
I think that, of course, the role of Europe is very important. If you take the present constellation of, I would say, GDP of the various economic entity, so nothing to I would say, minimize the whole of Europe. That being said, we have the chance, it seems to me, to have an ECB which was up to its responsibility in the time of crisis. And if I take into account the experience of the euro, we had a beginning which was without crisis, but with the immense challenge to create, I would say, credibility and authority for the new currency, which was starting from scratch. And then we had the crisis you mentioned, that Janet mentioned so eloquently, and all the successive crises. We are living in a permanent time of crisis. The most dramatic one was perhaps the permanent threat of deflation, materialization of deflation that we had during 10 years after the big financial crisis. So again, back to Europe, I would say that we see, but perhaps I'm too optimistic, so I have to be prudent there, but we see a big change after the great financial crisis, because there has been progressively an agreement on what was the definition of price stability, namely 2% in the medium term. We had that at the moment of the setting up of the European Central Bank. The UK Central Bank joined that. The US decided, and it was a very courageous decision, as far as I take it, seen from here, that price stability would be defined as 2% in the medium term, in the time of Ben. And then Japan, it was in 2012, and Japan in 2013 said the same. So at the moment I'm speaking, I hope very much that it will not change, but of course we'll see. We are not the master of the future. But at the moment I'm speaking, the four currencies that are issued by the major central banks of the major advanced economy, namely the dollar, the euro, the yen, and the sterling, have the same definition of price stability. It is something which is extremely important, in my opinion, not taken so seriously by academia, but it seems to me that at the moment I'm speaking, it's remarkable because since the explosion of Bretton Woods, it is the most important, dramatic change in the international monetary system that we had, again, since the end of Bretton Woods. So that makes me a little bit more optimistic on our capacity, despite all the challenges, to maintain stability, price stability and financial stability.
Thank you for that. Another mega trend to contend with is technological acceleration and the rise of cryptocurrencies and digital currencies. James Bullard, the debate around central bank digital currencies has evolved with the rise of dollar-linked stablecoins. Does a digitalized dollar sponsored by private actors enhance the currency's global reach, or does it create new risks, according to you?
Yeah, I'll answer that, but I want to agree with Jean-Claude first that I do think the European Central Bank is better protected on independence because it's a central bank formed by treaty, so I would definitely agree with that. In the US, it's formed by legislation. I don't think that the Congress has any intent of changing that legislation, but both politicians on both sides of the aisle, are the most extreme parts of the political spectrum, are finding ways around what's in the legislation in order to whittle away at the independence of the Fed. So I think that's the risk on the US side. And I also agree on the 2% target. There are sometimes forces in the US, intellectually speaking, and elsewhere that want to go to higher inflation targets, prominent voices. I think it would be an absolute disaster, so I'm agreeing with Jean-Claude, to abandon those inflation targets, and especially for major currencies. That would be the return to the 1970s, I think, is you'd get other countries then saying that it wasn't so important to keep inflation low and stable. You'd have higher and more variable inflation around the world, volatile exchange rates around the world. So it's just a lot of volatility that we would not need. On cryptocurrency, this is privately issued currency. This is relatively new on the scene, relatively small even today. So I don't think we're in imminent danger, but I do think that this poses risks. The stable coins in particular sound like fixed exchange rate regimes. And what do we know about fixed exchange rate regimes? They usually buckle at one point or another. There's usually a crisis at one point or another. So I think it's mostly introducing, from a central banking point of view, it's mostly introducing risk. And I would encourage crypto advocates here to think about business cases for cryptocurrency and its offshoots that are not based on regulatory arbitrage. If it's going to be based on regulatory arbitrage, it's going to be at odds with governments all over the world all the time, and maybe eventually that leads to more draconian regulation than what's around today. But if the business case is more of a plain vanilla, I can improve technology, I can improve payments, and do it in a way that can't be done today in financial markets, then that would be a great thing, and that would be technological improvement, and that would be great. So I think there's still this tension about, a lot of the business cases are cross-currency payment or cross-country payments and related things. A lot of them are illegal sorts of transactions. I would put those all in the regulatory arbitrage group. And so what you really need is a major application that's not in that sort of a bin, and that we can all benefit from. And if that happens, then I think the privately issued currencies will be extremely helpful going forward.
To conclude this conversation, I'd like you both to share your vast experience with us and maybe tell us about the qualities that the next generation of central bankers will need most. If the decade since 2008 was one of abundant liquidity, what is going to define the next era of central banking, according to both of you? President Trichet.
Thank you very much. I would say first that we have, and I fully agree again with James, to stick to what we have as a concept now, namely targeting inflation, and have this accord, which is a de facto accord. There was no negotiation in Basel that concluded that 2% was exactly what we needed. I trust that it is the case, but it was decided independently by all the major central banks that I mentioned. This is a major advance. Again, I share the views of James, and we should keep that, in my opinion. Keep independence, of course. We have all demonstration that independence, and of course independence vis-à-vis all, I would say, pressures, but they can come, and we know that they come often from the governments, which is not too surprising because the time horizon of governments is much shorter than the time horizon and the mandate of the central bank. So you have a permanent tension, which is normal, and that's the reason why there is such a strong consensus for independence of the central bank. And for the rest, I would say, be prepared for anything. There are so many structural changes in the world today, so many structural changes, not only economic, technical, the blockchain you mentioned, but also, of course, AI and so forth. So we will have a lot of shocks. I have myself experienced during all my life a succession of terrible shocks. We have forgotten today, but the debt crisis of Latin America, Africa, Soviet Union, Asia has been absolutely terrible. Now it's forgotten. So let's be prepared for anything. And I will pursue what you said, but in 30 seconds. When we realized that crisis could come anytime without early warning, this idea of stress test was generalized. And it was at that moment that we invented not only the central bank, but also the surveillance authority, the stress test. And we have to continue to practice stress test to be sure that we can cope with any kind of new dramatic events.
Yeah, I think the next 10 years will be maybe two themes that I'll just touch on here. One is increasing great power competition, and the good news is we've seen this in the past. The bad news is it's going to be more volatile than what we're used to. But certainly China, a rising India, the fastest growing country in the world and the largest by population, US on a technological wave, Europe very powerful, Japan, many other countries competing. I think it's and fractured, much more fractured than it was after the end of the Cold War in 1989. So I think this is the reality, and I think we have to get used to that reality. I think we are, and price everything accordingly. I think that means more resilience in our systems, including our regulatory systems, than we would otherwise build in. If you felt all your partners were super trustworthy, you might go with just-in-time inventory and similar sorts of ideas. But if you feel like relations are a little more tentative than that, you might want to build something that's a little more resilient. And I think that will be a theme going forward. The other theme is technology, and it's really coming. The AI boom is very real. The build-out is incredibly large. The amount of money that's being spent in the U.S., dwarfing what was spent on railroads, dwarfing what was spent on automobile highway build-out, dwarfing the space program. The only thing that's bigger in history is the Louisiana purchase of territory west of the Mississippi from Napoleon. So it's quite the spectacle. I know we're all wrestling with it, but it is the next wave of technology. There will be winners and losers. Not everything with AI in it or pretending to have AI in it is going to make money, and you should be wary of that. But the technology is real, and it is going to improve productivity going forward. So the positive hope is that we would get something like the second half of the 1990s in the U.S. With rapid productivity growth and rapid economic growth. That would also help with the fiscal problem. But none of that is here yet, and so it's speculative at this point.
So to wrap up, in terms of the qualities required, humility, maybe? Willingness to learn, always?
Always humility. We're in the macroeconomics business, so we're not going to get all that much right. So when you do get it right, you should celebrate that, and you should pass that on to the next generation of leaders, as Jean-Claude is doing here. There were a lot of hard-earned lessons that we need to continue to copy going forward.
And from your side, President Trichet, optimism, maybe?
I remain optimist, but provided we would be, I would say, very, very keen on examining all what can happen, the famous stress test, because until now, we could cope with all the drama that we had emerging. When we created the ECB, we did not imagine that we could have the worst crisis ever at the global level, economic and financial, and then the COVID, and then the threat of materialization of deflation. So again, be prepared for anything. And it seems to me a good recipe.
Fantastic. Well, many thanks to both of you for your precious insights here. Jean-Claude Trichet and James Bullard, ladies and gentlemen.